Hello everybody, welcome to JAIIB CAIIB English Medium channel. First of all, a very happy Dhanteras to all of you. The festivities have already begun officially, and when we talk about the small offering from our end right now on the JAIIB and CAIIB Mahapacks, we are running heavy discounts. You can apply the coupon code that is Y1003 for maximum discounts. And when we talk about the contact number where you can contact us right away, it is 0981 981 9247 for resolving your doubts related to our courses. Okay, so today's agenda, let's jump on to that. Today we will be doing the third part and the last part also of our module B in IE and IFS. Okay, so this will be the last part, and if you have not watched the previous parts, it is highly recommended that once this session is over, you must revisit them and start making notes also. Revision will be the key from the upcoming week, because we'll be having only 2 weeks for our examination and the remaining 14 odd days must be dedicated for revision. So let's try to solve the questions. First one, which among the following sections of the RBI Act consists of provisions with respect to accountability of RBI with respect to the inflation targets? So whenever we talk about the RBI Act, it has been amended along with the Finance Act, right? The Parliament has amended this particular act. And when we talk about the inflation targets, there is a specific section in the RBI Act which has been added, which was pertaining to the monetary policy. So there are two sections which we have to remember for our examination. One pertains to the 6 members monetary policy committee, and the another one is the inflation target. So the right answer for this particular question will be accountability of RBI will be there under section 45ZN. Okay, that is very, very important. ZB talks about the 6-member MPC. Which of the following is not a direct component used in the calculation of MCLR, marginal cost of funds based lending rate? So always remember, MCLR is just an internal mechanism of respective banks so that they can calculate their rate of interest. Okay, so various banks have their own rate of interest, which is based on an internal mechanism, and that internal mechanism is utilized under the MCLR framework. So we have 4 components under MCLR, and which of the following is not a part of this 4 components? So marginal cost of funds, do we consider it while calculating MCLR? Answer is yes. Negative carry on CRR, again, one formula is also there which you must remember for the exam, and it is a part of MCLR calculation. Operating cost also, plus tenor premium as well, right? Tenor premium, the premium for lending, fine, because you are doing a risky business. Then D, external benchmark, which is the wrong component in MCLR and the right answer for this question. So D is the right answer. External benchmark rate, also known as EBLR, which is having again 4 different components, starting from the repo rate, then the T-bill yield for the 3 months, then T-bill yield for 6 months, and FBIL recommended any other regulatory measure. So out of these, you have to select the EBLR. Mostly we see that repo rate is being considered as the benchmark rate. It is the ultimate EBLR for various banks. So for this question, MCLR, always remember the 4 components are marginal cost of funds, negative carry on CRR, operating cost, and tenor premium. Next, we have a question based on CRR SLR. In the last class also, we have seen one question based on CRR SLR. Why we are having another question? Because it is very important topic. Every year, one question is asked from here. Normally, students feel that repo, reverse repo from here questions will be asked. But IIBF always, it is very consistent to ask the question from reserves. So, which of the following statements accurately distinguishes between cash reserve ratio and statutory liquidity ratio, that is SLR in our country? So, CRR is maintained by the banks in the form of government securities, while SLR is maintained as cash reserve with RBI. So, as you know, that CRR is in the form of cash and cash equivalent, and SLR is maintained in the form of liquid assets, in which cash is also one of the component, but apart from that, you have gold and G-Secs also. So A is wrong. CRR primarily aims to ensure bank solvency. SLR primarily aims to control the money supply. No. CRR is for money supply and solvency is being ensured by SLR. Fine. This is solvency. Again, this is wrong. CRR is a percentage of banks deposit held with the RBI. Yes. SLR is a percentage of banks deposit held in liquid assets like government securities. This is absolutely correct. And the correct answer will be option C only. The last statement, CRR is used to manage long-term liquidity, while SLR is used to manage short-term liquidity. No, it is the other way around, that CRR is for maintaining the cash reserves of our country, and SLR has a long-term objective of ensuring the liquidity is maintained. Fine, here look into the L of SLR, liquidity to be maintained in a longer run, and that liquidity is maintained via lending. Okay, so that is why we say that SLR is for long-term liquidity and the short-term liquidity is ensured by CRR. Next, we have a formula-based question. Consider the following economic data for India. Private consumption expenditure, that is C, is given as 5 lakh crore. The GDI, gross domestic investment, as 2.5 lakh crore. Government expenditure G as 1.5 lakh crore, exports as 1 lakh crore, imports 1.2 lakh crore. Along with that, net factor income from abroad is 20,000 crore. So we have to find the GNP, gross national product. So always remember, GNP is nothing but GDP plus net factor income from abroad. If you are well versed with the formulas now, then one thing I would like to share with you, in IFS you won't have any trouble while solving the formula based question, because they are fairly easy as compared to other subjects. All you need is to remember the correct formula. So for GDP, what is the formula? In the expenditure method, it is C plus I plus G plus X minus M, where C stands for the consumption or by the consumers, the expenditure there. Then I for the investment by the investors, that expenditure will be there. Government's expenditure with G. X is for the exports and M is for the imports. Okay. So X minus M is ultimately known as net export. Fine. So just you have to add all these things, C plus I plus G plus X minus M. And lastly, you have to add the net factor income from abroad. You will arrive at gross national product. So the right answer will be option B, that is 9 lakh crore. Okay, here you can see that we have simply added all these components and we have arrived at the GNP as 9 lakh crore. What is the basic difference between GDP and GNP? It is just the NFIA. If you know that there are certain Indians who are residing in foreign countries, right? They are residing in the foreign countries, but they are remitting their funds in the parent country, that is India. And there are certain foreigners who are residing within our country and they are remitting the funds to their own homeland. Okay, so we have to exclude these numbers and we have to include these numbers. That inclusion and exclusion of this is known as net factor income from abroad, and this has been added to the GDP. Then only you will get the GNP of a country. And in India, we see that GDP contribution is rising since 2023. Next, we have a question based on GVA, that is gross value added at basic price. So which of the following is the formula for GVA at basic price? GVA at basic price, whether it is GVA at factor cost plus production taxes plus subsidies, or do we have something other than this? Because in basic price we know for sure that we are just adding up the initial cost of production, right? Only the initial cost is added, but as we move towards the market price, there you will find the final price of a particular commodity. Similarly, in the factor cost, the cost of production at the level of factory is evaluated. So what which of the following will be the correct answer here? Always remember GV at basic price, you have to add the taxes and subtract the subsidies from the factor cost. So whatever the cost is there in the factory when you are just initiating the production, there you add the production taxes and subtract the subsidies provided to that particular factory or the industrial unit, you will arrive at the GVA at basic price. Next, we have which of the following is not a tax revenue of central government. So there are various types of tax revenues in for the central government. The tax revenue being all those taxes, fine, being the corporation tax, GST, IGST, SGST. Then we have different levies also, cess as well. Fine, all these clubbed together are termed as tax revenue. You have to tell me which of these is non-tax revenue of central government. So compensation cess for GST, it is a tax revenue, definitely corporation tax also, as well as union excise duty. The receipts which the central government has from the union territories, that is UTs, it is a part of non-tax revenue, and that is the right answer for us. Okay, here you will see that the revenue receipts, it includes tax revenue, which includes corporation tax, income tax, wealth tax, GST, then customs, other taxes, union excise duties, service tax, your taxes of the UTs as well. Non-tax, you have interest receipt, dividend profits, external grants, other non-tax revenue, and receipts of union territories. So receipts of union territories, they form the part of non-tax revenue. And additionally, when we say the total revenue receipt will be what? Non-tax plus tax revenue, plus there will be some part when we talk about the net tax revenue, there will be some part of state's share and the natural calamity fund, which will be subtracting from the gross tax revenue. Which of the following part from your capital expenditure in the union budget of India? So capital expenditure means long term expenditure. The government is spending for more than 1 year in this particular domain. So whether it is for the securities against small savings, state provident funds, internal debt and public account, or none of the above. Indeed, none of the above will be the right answer, because all of these, they are not a part of expenditure. Leave aside the capital part. Okay, they are a part of capital receipts. The government earns money in the long term from the market borrowings, be it the government security T-bills. Then securities against small savings, the government is earning money. That forms the part of revenue of the government. State provident funds, other receipts, be it the internal debt or public account. Fine. So these are all the debt receipts, but yes, termed as earnings for now. Then we have Indian government's financial data for the fiscal year shows the following figures in crores of INR. You have to tell me the net tax revenue. Somewhere down the line, I have told you in the question number 26 that how you can calculate the net tax revenue. So you have the gross tax revenue figure with us as 25 lakh crore. NCCD transferred to National Calamity Contingency Fund as 50,000 crore. State share of taxes as 10 lakh crore. So what will the right answer? In the gross tax revenue, you simply have to subtract the National Calamity Contingency Fund, okay, by transferred by the NCCD. Then we have the state's share, which we have to exclude from the gross tax revenue, because as per the recommendation of Finance Commission, you have to provide the states their own share from the gross tax revenue itself. So just subtract these three terms, these three numbers, you will get the answer as the NTR, the net tax revenue, as 14 lakh 50,000 crore. Okay, simply 25 lakh crore minus 50,000 crore minus 10 lakh crore. Answer will be 14 lakh 50,000 crore. Then we have which of the following statements best describe the key difference between your SDF's standing deposit facility and reverse repo rate in the India's monetary policy framework. So SDF and reverse repo, you can say that both of them has a common area of explanation. That is SDF as well as reverse repo rate. These are the rates. They are having this rate of interest which will be offered by the Reserve Bank of India to the commercial banks. Fine. In order to park the funds of commercial banks with themselves with the RBI, this particular rate of interest will be charged. So SDF also somewhere down the line has the same mechanism. SDF is used by the RBI to inject liquidity into the banking system. No, we want to absorb liquidity by SDF as well as via the reverse repo rate. The SDF is an unsecured facility for banks to park excess liquidity, while your reverse repo rate is a secured facility where banks park funds with the RBI using government securities as collateral. So always remember, whenever we talk about SDF, it is collateral free. Currently, SDF rate is lower than the fixed reverse repo rate. No, we have SDF rate as more than 5.5%, less than 5.5, more than 5% basically, and the fixed reverse repo rate is 3.35%. That is why this is wrong. Both the SDF and the reverse repo rate serve the same purpose of absorbing liquidity. That is correct. SDF is used for longer term liquidity management, reverse repo for overnight purposes. So SDF is for the longer term liquidity management, but what about RRR? Whether it is for the overnight purposes or we have MSF for that, fine, marginal standing facility. So what will the right answer here? SDF right now, as you know, that the repo rate is 5.5%. And when you subtract 0.25 from repo rate, you will arrive at the SDF rate, which is 5.25%. So the right answer will be obviously option B, that the collateral free, you can say, lending facility is provided under SDF. And for reverse repo, you must have a collateral in the form of government securities. The Encasing Committee was formed to review the FRBM Act, that is Fiscal Responsibility and Budget Management Act in India. Which of the following was a key recommendation of this committee? So always remember, the Encasing Committee gave three major recommendations. All these three are important for the exam. To increase the fiscal deficit target to 5% of GDP indefinitely? Answer is no. Encasing Committee was just to review the progress made by the FRBM Act, and FRBM Act stipulated one direct aim for the central government to maintain a limited fiscal deficit, to reduce the fiscal deficit, not to increase in any form. To completely abolish all the fiscal deficit targets under FRBM? No. In order to have some more strict targets, to have some more strict measures so that our fiscal deficit does not exceed. To introduce a debt to GDP ratio target along with gradual reduction of fiscal deficit. This is indeed the right, you can say, recommendation of Encasing Committee, that gradually we will be reducing the fiscal deficit by mentioning the debt to GDP ratio target as 60%, out of which 40% will be done by the central government, 20% by the state governments. To immediately eliminate all the government guarantees? No, this was not correct. C will be the right answer here. Okay, so this was it for your last part of module B. Now we have concluded module A as well as module B on this particular channel. So if you have not watched any of the videos or you have missed one or two, it is highly recommended that before moving forward, do make sure that you have visited all the important videos of module A and B. Along with that, you have also made notes. In case you have any kind of doubt, feel free to contact me in the comment section. See you in the next session.